understand margin trading, and make it work for you. You've probably heard the term buying on margin, and you'd like to know more about it. Why do investors use it? What does it accomplish? Here's what you need to know. When you buy stock using margin, you borrow money from Investor's Edge to finance part of the purchase. You'll pay interest for the money you borrow, but you'll also need to keep the amount of equity in your account above a certain level. Let's use some simple scenarios to see what this all means. Let's say you're buying 100 shares of XYZ stock and the price per share of XYZ is $50. In scenario number 1, you pay cash for the full amount of the stock purchase. This will cost you 100, the number of shares, times $50 per share, for a total cost of $5,000 plus commission. Very straightforward. In scenario 2, you use margin. If the margin rate on XYZ is 30%, this means that you'll need to have at least 30% of the purchase price in your account when you initiate this trade, and it's possible to borrow the rest of the money from Investor's Edge. Let's do the calculation. 100 shares times $50 per share equals $5,000. 30% of $5,000 is $1,500. You'll need at least $1,500 of buying power in your account to make this purchase, and Investor's Edge will lend you the remaining amount. Here's a calculation for the maximum amount that you can borrow. $5,000 is the cost of the purchase minus the minimum amount of required buying power in your account, $1,500, equals $3,500, which is the maximum amount that you can borrow for this trade. Of course, you can borrow less, but this is the maximum. Interest will be charged monthly based on the average amount you borrowed during the period. The charge will hit your investment account mid-month and will either be added to the current amount you are borrowing or deducted from your cash balance. While there are no monthly minimum payments required, the interest charge will reduce your available buying power. The interest rate is tied to our bank prime rate. You can easily check the current rate on the Investor's Edge pricing page. Now let's look at maintenance margin in the next scenario. It's 1 week later and XYZ is now trading at $60. We already know that the margin rate for this stock is 30%, which means the maximum loan value for this stock is 70%. So you can borrow 70% times 100 shares times the current stock price of $60 per share. This amount equals $4,200. Remember that you originally borrowed $3,500 to buy XYZ, and so you now have additional buying power available in your account. Here's the calculation based on a $60 XYZ stock price. The current allowable margin is 70% times 100 shares times $60 per share, which is $4,200. Therefore, the excess margin is $4,200 minus $3,500, which was previously borrowed, and that is equal to $700. This gives you an additional $700 of buying power, which you can either use to buy additional securities or let it act as an additional buffer in case the price of XYZ drops back down. Let's look at that scenario. 1 month later, there's a negative news story about XYZ and its price drops. It is now trading at $30 per share. Since its maximum loan value is 70%, you can only borrow 70% times 100 shares times $30 per share, which is equal to $2,100 based on its current price. Let's recalculate your margin position based on a $30 XYZ stock price. The current allowable margin is 70% times 100 shares times $30 per share, which is equal to $2,100. The margin requirement is $2,100 minus $3,500, which is the previously borrowed amount. That is equal to negative $1,400. This means that your account is under-margined by $1,400. In investment terms, you'll receive a margin call, and you'll need to deposit additional funds in your account, transfer in additional margin-eligible securities, or sell existing holdings to cover your margin call. If you don't take action, Investor's Edge may do so on your behalf to bring your buying power back on side. Let's talk for a minute about the margin rate for different stocks. This rate can change without notice and can be influenced by many factors, including the stock's volatility, current price level, and other factors. If the stock's margin rate drops and your account does not have sufficient buying power, you'll receive a margin call. Also note that if a stock that you purchase on margin goes to zero, you're still responsible to repay the original margin loan plus interest. Just from these simple examples, you can see that there are advantages and disadvantages to using margin in your investment account. Let's summarize the main ones. On the plus side, number 1, increased buying power. Using margin, you can borrow funds to purchase additional stocks, which increases your exposure to potential market gains. Number 2, leverage. Using margin gives you the ability to control a larger investment portfolio with a smaller amount of your own money. This can increase your potential returns, but losses are also magnified. Number 3, diversification. More buying power means more opportunities to diversify your portfolio, as you can invest in different companies, sectors, or industries and reduce the impact of individual stock performance on your overall portfolio. Number 4, flexibility. You do not need to sell a stock to take advantage of another opportunity or wait for funds to settle as you would in a cash account. But there are also potential negatives. First, increased risk. We mentioned that margin trading amplifies your potential gains, but it also amplifies your potential losses. If the market moves against your positions, your losses could exceed the amount you initially invested, and that could lead to a substantial loss of capital. You should carefully assess your risk tolerance and have a solid risk management strategy in place. Number 2, interest costs. As we said, when you borrow funds to trade on margin, you're subject to interest charges on the borrowed amount. These interest costs can eat into your returns, especially if you hold the positions for an extended period of time. Number 3, margin calls. Earlier, we looked at how margin accounts require maintenance margin at a certain margin level. If your investments decline significantly, you can face a margin call, which requires you to deposit additional funds or sell securities. If you don't meet the margin call, some of your positions may be liquidated by Investor's Edge. Number 4, emotional pressure. Since losses can be magnified with margin trading can mean additional emotional pressure. It's important to keep a disciplined and objective approach to trading and avoid impulsive decisions driven by market volatility. Number 5, complexities and regulations. Margin trading involves various rules, regulations, and borrowing conditions set by brokerage firms and regulators. It's important to thoroughly understand the terms and conditions and the risks associated with margin trading before you do so. Margin trading can be a great tool to leverage your investments and increase potential returns, but it comes with an additional risk and requires prudent and disciplined management. Learn more about margin trading in the Investor's Edge Learn library. Happy trading!